Hey, what's up, everybody? So today I'm going to be talking about a couple different stocks that I'm buying today, and they're just trading at really, really cheap prices, low valuations, a great PE ratio, and really talking about a very specific industry, the industry being the steel industry. So if any of you have been following the whole steel and stocks related to that, you would know that it's been down quite a bit the last couple months, but I do think 2022 is going to be a big turnaround, and that's why I'm buying leaps, I'm selling puts, I'm buying shares, I'm doing whatever it takes right now to add to my portfolio so that we can make really big gains in 2022. Okay, so the first stock ticker we're going to be taking a look at is stock ticker VALE, VALE stock. Okay, so VALE is a Brazilian multinational corporation. It basically is engaged in steel, metals, mining over in Brazil. And taking a quick look at the charts right now, it's sitting at a really low P ratio of 4.14. It pays an incredible dividend of 19.77%. So I think this would be a great stock to actually own shares of rather than just buying options. But taking a look at the year-to-date chart, I started taking a look at this really honestly, in the summer, and it's just been down quite a bit, right? It's gone down all the way from a high of $22 all the way down to, I think the low was $11.27. But in the last month or so, it's been climbing up steadily and slowly back to right now $13.76. And so let's take a quick look at some of the fundamentals behind VALE. So right now, if going to FinViz is always a quick way to take a look at some of the fundamentals. So P ratio again 4.06. There's a forward PE of 5.35. Right now the RSI is sitting at 58.89, so it is slightly overbought, but that's completely okay. And it's just I think right now the stock is trading really really cheap for the amount of money that VALE is making. Taking a quick look at Yahoo Finance, we can find out a little more about some of the financials behind VALE. So VALE stock, okay, taking a quick look, you'll see that the financials for VALE are pretty solid. It's been growing at a pretty steady rate. Right now, their total revenue this year is insane. It's significantly grown in the last year. So it's actually a pretty healthy company. Their profit, the EBITDA, is 20, like just huge. They're making a ton of cash for this company. Taking a quick look at the Bollinger Bands, it's always a good indicator on whether or not it is a good time to buy. And so right now, as you can see, it's been dipping below the moving average. So I think right now is still a great time to buy. So how would I trade VALE if I were to trade options? Well, number one, as I mentioned, I would simply just outright buy out shares because they pay such a great dividend. And as you can see, I do have a couple of strategies open where about call options, and they are up pretty good, 67%. Okay, so but taking a quick look at some other options you could do, I wouldn't buy short-term call options because I really don't know how it's going to move in the upcoming months. I do think this is one of the companies that you want to give time for. So that's why I'm buying outright shares, or you can buy leap options. So leap options, you would just go far out, at least a year out. So I would set the expiration date to January 2023. You can buy deep in the money call options. So I can buy an option at even $12 will be perfectly fine, right? You would be able to open up a trade at just $2.67 per contract, so or per share. So meaning that the contract would cost $267. That is really really cheap, and the stock would only have to move up about 7.55% for you to start realizing a profit. I wouldn't go above the money, above out of money, because the stock would have to go up 21% before you start to realize a profit. If you wanted to go deeper into money, I think that's perfectly fine. You would just be paying a little more premium. So that's it for VALE. The next stock ticker that I want to take a look at, if you're not so much into, just Brazilian company, I would definitely take a look into steel. Okay, United States Steel Corporation, so stock ticker X. And as you can see right now, the steel corporation in the US is sitting at a really low PE ratio of 2.08. It has a market cap of $6.21 billion. Dividend yield is not as crazy as the previous stock, but It is trading at a really, really low P ratio, so I think this is definitely a no-brainer. Let's take a quick look at FinViz. Right now, VALE is sitting at, again, 2.08 of, P ratio, 4 PE of 2.26. The RSI is at 44.86, so it's slightly oversold. And just the price to earnings it just makes absolute sense, right? There's no reason why I would see, United States Steel continuing to go down, for the amount of money that I think it's going to be collecting, and for the amount of premium, not the premium, but for the P ratio that you're getting, you're going to be buying this at a great price right now. Taking a look at some of the financials, so as you can see, they've just made a lot of money this year. They're growing at a very, very healthy rate. Their profit margins are still great. And so, United States Steel Corporation, stock ticker X, is one you definitely want to take a look at. Okay, so right now, this is actually one of the stocks that I've solely bought leap options because they don't pay that great of a dividend. And so if I were to open up another leap option, I would go ahead and set my expiration date to January 2023. At least a year out, I'll go in the money. So I would probably just go ahead and buy maybe the $15 strike price. So you pay a little more in premium, but the stock would only have to move up about 5.84% for you to start realizing a profit. Okay, the other option I would do if I want more exposure into, X stock is I would consider selling puts. Okay, so you can get, X at a much discounted price, much cheaper price if you sell puts. You can sell puts all the way out into January 2023. So if the stock basically moves below $17, you would get assigned 100 shares, but you get paid a premium of $2.50 per stock, which is about $250 for opening that contract. If the stock never moves below that, you just simply collect the premium. But if it does move below $17, you would be getting X at a discount, and you would be collecting premium. And honestly, if I were to sell puts on X stock, I would probably just sell puts at the either probably the $20 strike, because I'm more than happy to have more of steel at $20. I think that's a steal, no pun intended. Okay. But a steel at $20 plus, you get paid a premium of $3.45 per share, or $345 for the contract. Okay, the last stock ticker that I want to take a look at is CLF. Okay, CLF stock. Okay, so Cleveland Cliffs is a company based in Cleveland, Ohio. Okay, no surprise. That specializes in mining, just iron ore, steel making, all that good stuff. Okay, there's a little more involved with CLF besides just steel, but it is sitting at a really low PE ratio of 5.27. That is incredible, with a market cap of $10.24 billion. Let's take a quick look at on FinViz to see how some of the other fundamentals match up. So taking a quick look, again, P ratio of 5.27 for P of 3.47. This is an incredible stock with, right now the RSI is slightly oversold, so I think it's a great time to buy. There's just so much in the pipeline for CLF. I read an article actually today about how some of the insiders, like the CEO and some of the top executives, have been buying a lot of their own stock. And whenever you have insider trading, it's a good sign that the executives have just a high bullish outlook on their own company. Okay, so they know a lot more than what the public knows. Taking a look at some of the financials, their revenue has just grown insanely, and like right now it's at more than triple the price of 2020. Okay, so CLF is pumping out cash, right? Their profit margins, the EBITDA is just incredible, and so right now CLF is definitely a buy. Let's take a look at what I would do with CLF. So I have bought leap options for Cleveland Cliffs, and the way you would open up a leap option would be you would go ahead and set your expiration date to a year or more out, January 2023. You would buy a call option deep in the money. I would probably just buy the call option at either $15 or $12, so meaning that the stock only had to go up about 6% or 11%. Depending on how much premium you want to buy, I think this is a no-brainer because this stock definitely has much more room to go. I probably wouldn't go at $20 because I would have to move up about 24%. I just don't know exactly how much it's going to move up. And I do think it's going to move up quite a bit, but I don't know when. So I would probably just buy it at the $15 or $12. The other option I would do is I would consider just selling puts. And I would be more than happy to own CLF at $15. I think that's a steal. So I would get paid, $2.14 per share, or $214 for opening this contract. If I get it signed, great. I keep the premium. I get the shares at $15. If not, then that's totally fine. I keep the premium. And a lot of people have been asking, okay, like, well, what about the collateral that you would have to put up to execute the trade? That's a great question. And that's why I highly recommend, Interactive Brokers. Interactive Brokers allows you to borrow off of your positions of up to 50, I think even more than that, at a really low interest rate of 1.59%. So if you need cash, if you need money for emergencies, you can always borrow off of your positions, and that way you're not stuck, you're not tied into these positions without being able to have some more liquidity. Okay, if you like my content, if you want me to make more videos like this, make sure you smash that like button, subscribe, comment below if you have any questions. Until next time, guys, happy investing, stay safe, and I'll see you guys in the next video.